Do you ever have that sinking feeling that even when you're doing everything right with money, somehow you're still falling farther behind?
Like the rules changed in the middle of the game. Work hard, save, be responsible. And yet, housing gets further away, costs keep rising, and more people are left wondering, what am I missing?
So, what if the answer isn't that you failed, but that the system itself has been quietly distorted in ways most people were never taught to see?
And that's exactly where today's conversation goes. Because this isn't about inflation, interest rates, or whether life feels more expensive than it used to. It's about a much bigger question. What if a lot of what we call economic growth isn't actually real prosperity at all?
Today, we're joined by Paul Musson, longtime professional investor and author of Capital Offence, to unpack a bold and challenging idea that many of the policies meant to help the economy may actually be making things worse over time, leading to fueling inequality, rewarding extraction over contribution, and pushing more costs onto future generations.
Today, we're talking about the difference between money and real wealth, and why so many people feel like they can't get ahead, and whether policymakers have been solving short term pain by creating even bigger long term problems.
And this episode is not all about conspiracy theories, and it's not just another angry rant about the economy. It's a deeper conversation about how money actually works, why so many smart people may still be getting it wrong, and what all of this means for normal people trying to build a good life.
So, if you ever looked around and thought, why does all this feel so fragile? Or why does it seem like some people are winning and everyone else keeps paying for it?
Because this one is going to challenge the way you think about money, markets, policy, and maybe even what real wealth actually is. This is the Fi Guys, episode 181. Let's get into it. Paul Musson, author of Capital Offence, welcome to the Fi Guys podcast. Thank you so much for joining me here today.
Well, thanks, Chris. It's great to be here.
I would love for you to give the audience a bit of your background, a bit of what led you to write the book, and kind of tell us your origin story, if you will.
Yeah, my origin story is unconventional, I would say, and it's a long one, so I'll sort of cut to the chase. Well, maybe I'll say that, like, through university, I had no idea what I wanted to do, and I already was late going to university. And but I knew it was important to be in school, so I just stayed in school. But my big passion was thirst for knowledge, reading history, a little bit of philosophy, geography, nature. I'm a bird watcher too, so all these things were my big passion. As Mark Twain said, I never let school interfere with my education. And
Mhm.
so school obviously very important, and then I sort of hit upon investment analysis, and I thought doing research on companies would be like really interesting because it incorporated a lot of things that I was very interested in. I was okay in math. I wasn't a math genius, but I did above average, I think. I loved the history and the psychology of it and whatnot. And it ended up being even greater than I ever imagined it could be, analyzing companies for a living. So I was very fortunate, um, loved my career. And it was a very circuitous route to get to where I got to, which is could be a whole other podcast. But bottom line is, I felt that I was not only did I love my job, but I thought that I was providing an important function, if you will, a role in the economy, in society. The way a free market capitalist system is supposed to work, which increasingly it doesn't, which is why people are getting angry. The way it's supposed to work is you're only supposed to benefit to the extent that someone else is benefiting from your actions. You create capital in some form, either in the form of a good or a service, and you fairly and freely exchange your capital with somebody else who created their capital, but we do it through the medium of exchange called money. So you create capital, you make a bike, I make a suit, we exchange that with each other. Nobody else out in the economy is worse off. Nobody suffered from that exchange and that creation of capital. Society is actually that much better off because more capital was created. So as an investor, I would take the savings of my clients who had created capital and wowed their customers or their bosses, whatever it was. And now they have this capital, they've consumed some, they give some to me and my team. We go around the world looking for who we think are the best and most responsible utilizers of that capital, who are going to put it to the most productive use to create more capital so they can pay my clients dividends. Or if they've borrowed money, it gives them the wherewithal to pay that debt back because they've created capital. And they do that by making sure that they're producing capital that their customers value. Customer value proposition, crucial. So when that's happening, when companies are producing more and more capital, their profit goes up, they hire more people, they pay them more. That higher profitability pushes their share price up. When most of the companies in the stock market are doing that, the stock market goes up. So when you see a rising stock market, that is a symptom of a lot of good stuff that's going on in the economy. That's a symptom of more and more capital being produced, and it's pushing the stock market higher. That's really good. But then central banks started short-circuiting the system. And at first, I was very naive with respect to what's going on. But the more I was trying to do this for my clients, then I would see what central banks would do, distorting the price discovery mechanism of capital markets, which we'll get into. I started to get increasingly angry because this is not the way it's supposed to work. So what they started doing was, the term I use is they started sacrificing the mainstream economy on the altar of higher asset prices. So instead of establishing the conditions for the most productive investment and allocation of capital to drive stock markets higher, they started driving stock markets higher first and try and drag the economy up with them. Yes, they know that the top 1% or the top 10% will benefit the most from this, but don't worry, the benefits of all this will trickle down to everybody else over time. Well, it didn't happen. And theory would tell you that it would not happen. And we can go into more specifics after if you're interested. So as I was witnessing this over the years, I've done hundreds or thousands of presentations to my clients over the years who are financial advisors, stockbrokers, planners who are trying to help their clients achieve their financial security. And I would explain to them what was going on. And importantly, I would do so in very easy to understand terminology. When I first started out in this industry, my goal was to impress people, try and make them think that I was smart. Use complicated, terminology, words and lingo and all this nonsense. And then they might not know how I was investing their money, but they might think I'm smart. Okay, well, he must know what he's doing. And for various reasons, I got sick of it and I'm ashamed of myself for doing that. And so I said, I'm not doing it anymore. I'm just going to be completely honest with people, but intellectually honest, which means not just giving people the raw truth, but giving them the truth in a manner in which they are receptive to that truth. And then empower your clients with understanding about what's really going on. Empower your clients so then they can empower their own clients, help them with their business. And it was, it took me a while to get there, but it was really liberating. And there's a saying that, when you tell the truth, you never have to remember what you said, right? So you never have to cover up your previous lies or anything. No, I just told the truth. That's it. And so over the years, clients, and people at my company were saying that, Paul, one day you should really write a book about all of this, these things that you are saying about what is going on, because you're the only one we know of who talks about it in the way that you do. And I thought, yeah, maybe, I had no intention of it. But then over the years, I was just getting angrier and angrier at what was happening because central banks kept going further and further down this rabbit hole of uh, price discovery distortion. There's the first rule of holes. When you find yourself in a hole, the first rule is to stop digging. Well,
Mhm.
central banks have been digging faster and faster over the years, such now that the hole is so big, it's really going to be difficult for us to get out of it. We still can, but it's not going to come without pain. So, anyways, I decided, this is a long answer to your question, but in 2019, I started writing the book. And I'd never written a book before, so that was a whole new journey for me, an experience, and a whole new learning. If you want to learn something, you learn by doing, you learn by speaking, you learn by saying, learn by teaching. You learn by thinking, but not as much, in my opinion. And I discovered this many, many years ago that, if you're just thinking about things, there's no one in your head to challenge you. All your strong convictions are very safe in your own head. It's only when you have to put them down on paper for the whole world to see that all of a sudden, oh, I better double check that.
Yeah.
And so I learned a lot in writing. So it took me 5 years, I guess. I mean, the book was completed a couple of years ago, but you go through the publishing process, and blah, blah, blah. And then I started a free blog in 2022 for similar reasons, just sending it to my wife and my 3 daughters so they would know what's going on, and then they were forwarding it to their friends, and that sort of grew. So now it's a weekly free blog that people can sign up for, just helping people understand what's going on. So that's how I got to where I am today.
Wonderful. During that, you mentioned the word that is very big for me. It's truth, and I'd like to hear a little bit about the book Capital Offense and your policy and what your thought process is. But what I'm seeing now in the economy, and I think what many of our listeners are feeling, is that there's something broken. There's something broken about money.
Yeah,
You look at housing, you look at inflation, debt, stock markets, feeling constantly behind.
yeah.
And I think, and this is not a political podcast, but people are beginning to feel like, okay, so capitalism must be broken. Capitalism must be the thing that's bad. But from reading your book, I mean, do you believe, Paul, that capitalism is the problem, or is money and policy the problem?
So
Where's the truth actually lie?
so it's not capitalism, it's not money, it's policy. I was listening to a podcast last week, a couple of weeks ago, and one person was saying that capitalism is racist. Well, no, it's, the example I would use in that case is, let's say you've got a hockey team and there's a black player on the hockey team and there's one white player who refuses to pass to him because he's racist. Does that make hockey racist? No, it makes that hockey player racist. Racism is a human thing, it's not a system thing. And money is not the issue either. A misunderstanding of what money is a big issue. Now, just backing up a little, and the reason I wrote the book is to give people a better understanding of how an economy really functions, what money really is. Now, the problem with economics is that it's a social science and it's not a hard natural science like chemistry or physics. And so there are a number of different schools of thought with respect to what makes an economy work. Now, some of these schools of thought, in my opinion, conflate ideology with the laws of economics. So they put forth the laws of economics as they would like them to be, not as they are. Now, the laws of economics can be very inconvenient. The laws of economics will tell you that you cannot have your cake and eat it too, that there is no such thing as a free lunch, that deficit spending and debt accumulation does have longer term consequences, that inflation is not good for the economy, all this kind of stuff, that consumption is not the fount of all economic prosperity. I mean, I wish it was. I'd love to consume my way to riches. It's a lot more fun than saving an investment and taking on that risk and all the time that's required to grow your capital. These are inconvenient. And, some economists have likened the absurdity of all this to blaming gravity, blaming the law of gravity for plane crashes. Stupid gravity. Okay, so let's come up with some formulas to get rid of gravity. No, these are the laws. So with the book, I've tried to give the understanding, okay, this is how it works. Now, we can now put an ideology on top of that, but don't replace the economic laws with ideology. And I'm not anti-government. I'm anti-big government, that's for sure. I'm anti-central control, central power, absolutely. But I'm not anti-government, and I'm not anti-welfare state within reason. But to have a welfare state that's not going to harm the economy significantly, you need the most productive economy possible. You want to be in a position where you can help people that can't help themselves, either permanently can't help themselves or temporarily can't help themselves. There's lots wrong with what's going on in the system, but it's not capitalism. There's lots wrong with the fact that there's not equal opportunity out there. And there are lots of people who work tirelessly to try and change that, and we need to do more. But that's not capitalism's fault. And there should be inequality of outcomes. But the inequality should be a result of effort, contributions. So, for instance, if you and I both own a bike company and you make 10 bikes a week, and I decide I only want to make one bike a week because I'd rather go bird watching the rest of the time, well, guess what? You're going to have 10 times the wealth of me. There's nothing wrong with that. That's perfectly fair. But what's happened in society because of central banks interfering with price discovery mechanisms of capital markets and to deliberately drive asset prices higher. Instead of the wealth disparity being here, it's now here. So a lot of this wealth has not only been unfairly earned, it's come at the expense of society. Now, this is not, as I said earlier, it's not a conspiracy theory. I believe that central banks actually believe that this was going to work out well for everybody.
Mm-hmm.
And those who have benefited the most from it haven't done anything wrong. At least from a legal perspective, they haven't. And you know what it's like, human nature. If you're doing well, you always put it down to your own brilliance that it's justified. It's like what's the definition of a financial genius? Well, it's a rising stock market, right? That's it. And so people don't realize how much they have benefited at other people's expense. And the classic example is housing, which I can go through now, or we can get into that later.
Let's get into that in a little bit. What I'd like to talk about is you said that the central bank is manipulating or perverting the incentives by changing things. So could you define for us how they do that? But before you do that, what is money? How do you define money? Because I think that may be able to get our guests who might be a little lost, or I think many people, when they hear about all this stuff, they think there's like a cabal of people. They don't really understand anything. So their brain just kind of checks out. So I would love to be able to go back, what is money?
Yeah.
And then how is it manipulated?
Sure. So all money is, so people need to differentiate between money and capital. So like I said earlier, capital is stuff. Let's say you make a bike, I make a suit. we fairly exchange that capital with each other. If we did that, that would be direct exchange or barter. But you can't have a large economy with barter because you have all these different prices, one suit for one bike. One suit is 20 chairs. One bike is, 100 umbrellas or whatever. It's too complicated. So we have indirect exchange through a medium of exchange, which is called money. So we use money to exchange all this capital, all this valuable stuff that we're producing. So, and that's all it is. And well, it's also a store of value, temporary store of value. And so you can have an economy with capital and no money, albeit a small one, but you couldn't have an economy with money and no capital because there would be nothing to use the money for to exchange with each other. So, but this is where the trouble comes when you put money into the system. So let's say you make 10 bikes and you sell them for $1,000 each. They're really nice bikes. So you got $10,000. You throw that into your bank account. You're going to save it to go on a nice trip at the end of the year. Now, what that $10,000 in your bank account effectively represents is the 10 bikes of capital that you produced. You've got $10,000 of spending money, but what gave you the wherewithal to go out and buy something was the fact that you created 10 bikes. Before you did that, you had no ability to go out and spend and consume. So you're going to use that $10,000 at the end of the year, but before you get a chance to spend that money, the central bank doubles the money supply. Now, when the central bank doubles the money supply, they don't create capital to get that money. They just create it out of thin air, push a few buttons. So it's got no capital stored up in it, but it obtains capital as soon as it comes into the economy. And it obtains the capital from the rest of the money already in existence. So as soon as the central bank doubles the money supply, it extracts 5 of the 10 bikes that were stored up in your $10,000. So now when your bank statement says that you still have $10,000 in the bank, so you're feeling okay. But because it now is only storing 5 bikes instead of 10, your $10,000 will only buy half as much as it would have done before the Fed doubled the money supply. So now you can't afford to go on that trip. And so it's inflation, right? Because the price is double. You've got 10,000, your trip costs 10,000, but now with the money supply, the price has gone up to 20,000. So that's the difference between capital and money. And now, in terms of how they actually drive asset prices higher, and we'll focus on stock markets because we'll get into housing later.
Yeah.
So when I said earlier about allocating capital to businesses and then putting it to productive use and that increased capital pushing the share price higher, that's a really good thing. But central banks decided they couldn't wait for all that to happen. So they would drive interest rates lower to increase the valuation of stocks, increase the price that people had to pay for all that capital that was being produced. Excuse me. So when you're valuing a company, you're just discounting the future cash flows of that business. And the lower the interest rate, the higher the value. And so central banks started driving interest rates lower to drive stock markets higher because it would result in what they call a wealth effect.
Mm-hmm.
Now, a wealth effect means that as your stock portfolio goes higher, you feel wealthier, not because you are, and you might use that stock portfolio as collateral for loans. And then you use that borrowed money to go buy a new SUV or a widescreen television or extension on the house. And policymakers like that because this is all final spending or consumption. And GDP is a measure of all final spending in an economy, 2/3 of which is consumption. So they like the fact that you are driving that GDP number because it looks like the economy is in good shape. But if GDP is rising with final consumption, just because you're pushing stock markets higher, it doesn't mean that it was rising because more capital was being produced. Just that the price of that capital was getting more and more expensive, and those who owned that capital were benefiting. And so it's like a fake wealth effect, is what I like to.
And is that because, Paul, more money was put into the system and then chased the asset? It chased the thing that was finite rather than the thing that could be infinite?
Exactly. So first of all, your lower interest rates, it just increases valuations of stock markets, but it also encourages more borrowing. Now, many years ago, and all these issues transcend politics, by the way. It's both sides. So many years ago, policymakers and central bankers started encouraging debt-fueled consumption to drive the economy forward because they think consumption is the fountain of all economic prosperity. It's not, it's saving and investment. Now, when you encourage debt-fueled consumption and lower interest rates, of course, people are going to respond accordingly. They don't need any encouragement to spend their money. As you know, if anything, people need encouragement to save money, right? That's harder. And so you get people to take on debt and consume, but after a while, when they get up to this sort of debt level, they can't take on any more debt to consume. And so their spending starts to slow. And so the central bank will lower the interest rate so the consumers can service more debt and go spend again. And of course, it happens. GDP goes up again, and central banks think mission accomplished. Oh, but guess what? Now they've got even more debt. They can't continue spending. And so the central bank has to lower the rate even more. And this is called the neutral rate of interest. So the neutral rate of interest is that which allows for or enables enough debt-fueled consumption to keep GDP growing while not causing inflation higher than their 2% confiscation rate. You don't need 2% inflation for the economy to grow. It's a myth. Bad one, too. And so they have to keep lowering the rate to allow people to take on more and more debt. And then these policymakers are mystified that over the decades, for some reason, the neutral rate of interest keeps grinding lower. I mean, this is common sense. Now, but rather than admit that they may have caused this through their policies, they instead will trot out all these excuses like global secular stagnation. They love these terms, right? It sounds really impressive. This is the reason why the neutral rate has been going lower and lower and lower. Yes, we do have global secular stagnation. It's because of your policy. That's what caused it. Now, so the neutral rate kept going lower and lower and lower to allow more and more spending, which also drives asset prices higher. There's what's called the natural rate of interest, which is very different from the neutral rate. Now, these two rates are conflated by many people. So the natural rate of interest is that determined by market players with their own skin in the game. So if you're deciding you're going to lend Apple $10,000, you're going to look at their sort of product life cycle and what the new iPhone might look like, whatever, how much debt they already have. And do I trust this company? Are they going to be able to pay me back? And if you have any doubts, then you're going to require them to pay you a higher interest rate to account for the higher risk that they might not be able to pay you back. So let's say you decide that 8% would be what you were comfortable with based on the return or the risk that you were taking on. But central banks might decide, well, Apple can't afford to pay you 8%. And so we're going to drive interest rates lower and force you up the risk curve and force interest rates down for Apple so they only have to pay 5% or 4%. or whatever. At one point, you had some corporations in this world that were paying zero or even negative interest rates. So you had to pay some governments and a few corporations for the privilege of lending them your money. I mean, how absurd is this? So if the government is not involved in that, when you got millions of people and businesses all making these risk return decisions with their own skin in the game, or the responsibility for other people's capital where they will be held to account for the outcome, you end up with a natural rate of interest. So let's say it's 6%. This natural rate of interest results in the most efficient allocation of capital, results in the most productive economy, results in the most capital being produced within the system, and by the way, fairly distributed. So let's say it's 6%. Now, remember years ago, central banks started focusing on the neutral rate, that not about the natural, but the rate that allowed for the most debt-fueled consumption without causing inflation. And so over the years, the neutral rate kept going down because the amount of debt kept going up. And each time they took the neutral rate down, they took it further and further below the natural rate, further and further away from the optimal rate of interest. And so productivity growth in developed economies has been grinding lower for decades on average. I mean, you have to smooth out the curve. And again, they're all mystified with respect to why this is happening. Oh, it's demographics. No, you caused it by trying to short circuit the price discovery mechanism of capital markets, which is so important. And and so here we are. And I should say that one other way that they specifically drove asset prices higher was through something called quantitative easing, or QE, which I'm sure your listeners are familiar with. And again, this is not a conspiracy. They will tell you that they were trying to do this. So in the wake of the great financial crisis in 08, 09, they started printing or creating trillions of dollars. And through what they call the portfolio effect, the goal is to drive stock markets higher, all asset prices for that matter. And they bought trillions of mortgage-backed securities, which served to drive mortgage rates through the floor. We'll get into that. And actually, I cite a paper in my book that was written by a Fed member in 2013. And he talks specifically about this, the portfolio effect, and how they were trying to do this. And most people think that, a lot of people think that the Fed was buying assets from banks, long-dated treasury. No, the banks were just conduits. The majority of treasuries and mortgage-backed securities were bought from hedge funds through the banks. And so, and in their mind, mission accomplished. That's exactly what they did. They drove asset prices higher, stock markets higher, housing prices higher. That benefits those who own the assets. It comes at the expense of everybody else. So for years, people have got virtually nothing on their savings. And there's another report I cite, I think it was from McKinsey, that whatever it was, $2 trillion in interest expense had been saved for governments and corporations because central banks took interest rates to zero. Well, that's $2 trillion of interest income that the lenders of that money were denied, that they deserved. A redistribution of wealth within the system by central banks because they thought that was what should happen. And so, anyways.
I think this might be really important, Paul, because I feel like when a lot of people, they hear about the central bank printing more money, most people don't understand that. And they think that's probably a good thing because then they're just going to they're going to distribute the money equally to everybody else. So then it doesn't really matter if the prices increase because my money will increase with that.
Yeah.
Could you maybe tell the listeners the mechanisms of how that money is distributed and why it only goes to a select few people and not to everybody else, and further creating this K-shaped economy that we are currently seeing? And I think that might be a good transition into what we're seeing in housing.
Yeah. Yeah. So when they create money, it first finds its way into the system through the financial system, through banks, through hedge funds, through whatever. Now, earlier, like you just said, like if they just distributed money to everybody equally, then the impact of that increased money supply would be what they call neutral. There, so yes, so if they double the money supply and evenly distributed it, then eventually prices of everything would double, but you've got twice as much money. So in real terms, you're not any worse off. But the increase of the money supply is not neutral. Some get access to it or benefit from it before others do. Eventually, the money trickles its way through the system over the years. And by the time the people, the lower income primarily, by the time reaches them, prices have increased more than the amount of money that they've received. And so they are worse off. Now, I haven't really given you a great explanation, but that's sort of what happens. It's not neutral. And again, I have to sort of re-emphasize, if you will, that I do believe I don't believe they're bad people. I do believe, I mean, they're arrogant. Uh, absolutely. And I think are more concerned about their reputation than, okay, I'll stop there, but they're not bad people. I really do believe that they thought that doing all this would be to the benefit of everybody. But they want to be seen doing something. They like to think that they know what they're doing and that they're in control, justify their existence, if you will, rather than just get out of the way. And it's hard to take credit when you're just getting out of the way. But I give those people the most credit of all because that's the hardest thing to do. So, and I talk about this in my book, where you're working somewhere and everything's going just fine. Your team, you're doing a great job. And then your boss has to come in and tries impose himself on what's going on and justify their existence and screw everything up. No, we know what we're doing here. And that's how I sort of think of central bankers justifying their existence, justifying the fact that they like tinkering with the system. And they love the applause of and the adulation of Wall Street and CNBC and all this kind of nonsense. All this stuff is really bad for the economy, really bad for Main Street or the Main Street economy. And anyways, yeah.
When you say the word Main Street, could you define that? I mean, maybe define what Wall Street is versus Main Street, because I think most people, they think the economy is the economy, and they don't really realize that there are different versions of. There's a big word, and then there's the things below that make up that big word.
Yeah. So the way I differentiate it from like Wall Street is the finance industry. Now, the finance industry is very important. I was part of that my whole career. But finance, for the most part, just like government, does not really produce any capital. Finance and government are, for the most part, facilitators of capital creation in the real economy, in the private economy. And so, very important roles. But over the years, both government and finance have grown as a percentage of the economy. Now, in terms of, so in government, government, doesn't create any capital of its own, right? So government, all the capital the government spends, it first obtains from the private sector through taxation, through borrowing, or through printing money, extracting spikes from your $10,000. And so the bigger government gets, the harder the private sector has to work to fund it, to fund all that spending, fund itself. Same thing with the investment world. And I think, a lot of hedge funds and whatnot, again, not bad people, but I question how much value they're adding to society. And in many cases, they're not adding any value and they're detracting from value.
Yep.
And they're just trying to make money from each other. And a lot of the best and brightest now who are leaving university rather than study engineering or medicine or whatever to really add to society, instead go to Wall Street because you can make a lot more money a lot faster in a hedge fund by outsmarting other hedge funds. And so people making money from each other at the expense of other people. Now, there's nothing wrong with it because it's all above board and nothing illegal. Everybody knows what they're signing up for. If you invest in a hedge fund, you know that you could lose it all.
Uh-huh.
But it's not that your capital, for the most part, is being put to productive use. It's like this massive casino. And I liken it to a massive game of poker. So at the table in a game of poker, no capital is being created. It's a redistribution of wealth at the table. And at the end of the game, you end up with one winner and a bunch of losers. And increasingly, that's how people are starting to feel our economy is. A few winners and a bunch of losers, because the system is rigged inadvertently, I would say, against most people. And and that's why I've written my book and my blog, why I'm doing calls like this to help people understand what's going on so we can change it before it's too late.
Yeah. And I'd like to even challenge that a bit more. And please tell me
Mhm.
if where I'm wrong here, that, if we're using that casino, that blackjack table and everyone's sitting there, it's even worse than that, in that there are certain people that aren't even at the table. Or the way that the central bank, when it releases money, these people get to play their whole game and then figure out who the winners are. And then based off of that, they'll give their tips to the other table and be like,
Yeah,
yeah, here, you guys can go play with your own little game over there. So we
yeah,
have, in truth, two separate economies. And remember, like, call it shadow bank, call it whatever you want, but there's the big boy economy where they're playing their own little game. And then there's everybody else. And, the big boy game is probably 1 to 5% of the population, and the rest of, the 99 to 95% are sitting outside of it, getting the scraps of what people like drop off the table, the chips that might just fall to the floor.
absolutely. And central banks have distorted interest rates to levels that support this sort of behavior at the expense of the mainstream economy. And yeah, so you're absolutely right. It's worse than even I am saying it is, and I do talk about this in the book.
So I like to move a little bit to housing. And, I believe that housing, it works because it is the only thing that those who are not have financial acumen intuitively understand. Like, if I buy a house increases. I get that. Like, I can't live inside of my stock portfolio. I can't live in my Bitcoin. I can't live in anything. But this house, if I purchase it, it should appreciate and eventually create generational wealth. Like, that's what we were sold. That was the American dream, right? And everyone believes that. I call that a money meme, just something that you believe intuitively because you've been told it so many times over and over and over again. And nowadays, for my generation and those younger, we look at housing as this faraway dream that will never be able to be attained. And it creates this sense of nihilism of what's the point? And now we see the economy decreasing. We see substantially less births, substantially less marriages, substantially less everything, because we can't get on the first rung of the ladder, to which our society says, like, this is the first hurdle you must clear in order to begin the rest of your life. How did we end up in this situation?
Yeah. So just adding to what you just said there, because the average age of the first time home buyer in America is now 40 years old.
Yep.
Back in the 90s, it was 31 or something. I was listening to a podcast last week with an economist, he has pointed to the global fertility rate, it's just shocked me, is actually below replacement. So it's 2.1 or something like that. It needs to be just slightly higher. And he says that the main reason the global fertility rate has declined in the world is because of soaring house prices. So it's an American issue. It's way worse here in Canada. It's way worse in Australia. So this is really bad. And it served to, and I'll get into the mechanics in a second, it served to increase the time preference of society. Now, let me explain what that is. You mentioned earlier that we were all sold this dream of you buy a home, you get on the housing ladder, you sell it for an extra $100,000, you move into the next one, your house price goes up, and now you have this wealth that you can retire on. And that's what was happening. So that confirmation. Well, the result of that was that people my age, I'm 64, I'm a baby boomer. Baby boomers saved less money than they otherwise would have because they expected to rely on the value of their home to retire. Now, when society is saving less and consuming more, that means their time preference has increased. If your time preference is low, that means you're okay with not consuming as much today. You're willing to save more of your money and invest it. So in a society with a low time preference who saves more and consumes less, over time creates more wealth because more capital is being saved and invested and created. Conversely, a society with a higher time preference that's consuming more than they're saving and investing, less capital is produced over time. So our economy is producing significantly less today than it would have done otherwise if central banks hadn't targeted housing prices. So what happened? So we had the wealth effect of the dot-com boom back in the 90s, dot-com era. Lots of real productivity improvements happening, lots of amazing things going on. But stock markets got carried away like they always do. But that was creating a wealth effect, and Greenspan used to talk about how many billions of dollars the rising stock market was contributing to GDP or final spending. Then you had the dot-com crash, you had a negative wealth effect. So people feeling less wealthy, borrowing less on their portfolios, and GDP was suffering. But that recession that the US had in 2001 was a very mild recession. It wasn't even 2 quarters of economic contraction. It was 1 quarter. Now, you had these commentators like Paul McCulley from PIMCO and Paul Krugman of the New York Times recommending that the Fed should start a new wealth effect, but create this one in the housing market rather than the stock market because more people own homes than stocks. And that will have a bigger impact on spending and GDP. And so this is my theory that the Fed responded accordingly. And so they took interest rates, Greenspan took rates down to 1% in an economy that was still growing. Now, these were like they hadn't been seen since the 1950s. These are like emergency level Fed funds rates. And yeah, so they were kept extremely low for 3 years. And of course, the housing market responded just like theory would tell you. You drive financing costs lower, you increase demand for housing. Housing prices started to soar. You had that crazy housing bubble in 05, 06. Now, of course, there were lots of players who, deserve some of the blame here. The recklessness within Wall Street, lax lending, ninja loans. Was it no income, no job, no assets or whatever? You'd still get a mortgage. And, but none of this would have happened if the Fed had not established the conditions for this to happen. And so housing prices are soaring. subprime debacle, the whole thing crashes. And rather than say, well, to themselves, well, maybe this was not a good idea. Maybe we should not have interfered in the housing market, interfered with people's decision with respect to whether or not they could afford to buy a home or not. No, they doubled and tripled down with QE, started buying trillions of dollars of mortgage-backed securities to drive mortgage rates, 30-year mortgage rate through the floor, and drive housing prices back up to where they are today. Now, this is really bad for the economy. It's really good if you own a house, but it's really bad for everybody else. Like I was saying earlier, in a free market capitalist system, you're only supposed to benefit to the extent that somebody else is benefiting from your actions. You created capital, a bike. I created capital, a suit, and we exchange that with each other. We're both better off. So any wealth that you have accumulated through your career is supposed to be a reflection of wealth that you've created and others out there cumulatively in the economy have because of you, right? So a mutual benefit system. Now, when your house price goes up, who else is benefiting from that? Nobody. So our house, we live in a suburb of Toronto. We bought it in 2001, just happened to be when Greenspan and then Bernanke started this housing wealth effect, garbage. And so our house is up 4 times, in nominal terms at least, from where it was in 2001. So if we make 4 times on our home, if we sell it, who else out there is 4 times better off? The answer is nobody. But it's worse than that. Somebody else is 4 times worse off than we are. Our benefit comes at somebody else's expense. Our house is not a productive asset. Our house is not producing 4 times the amount of stuff it produced in 2001. It hasn't grown 4 times in size. It's the same economic good that either a younger couple, next generation, or immigrants, newcomers to our country, have to pay us for the same economic good, 4 times what we paid for it. It's immoral, in my view, and it's not sustainable. Math doesn't work. I remember my mom used to be a nurse in Florida, and during that crazy housing boom in 05, 06, I remember her telling me that they were having trouble hiring nurses in the hospitals around the West Palm Beach area because based on their salaries, nurses couldn't afford to live anywhere near where the hospital was. They'd have to live like 2-hour drive away. So the math doesn't work, and it's just immoral anyways. So we're in this position now where the next generation is angry, and they should be. But a lot of people mistakenly blame capitalism for this, and it's not capitalism at all. Or they don't really know why they're getting screwed. They know that they're getting screwed. They know that they went to school just like their parents did, probably better educated than their parents, willing to work just as hard, but can't even dream of affording the same sort of lifestyle that their parents did. But not knowing why, not able to connect the dots between central bank actions years ago to outcomes today, second and third order effects. People need someone to blame. And so it's very natural that, in my opinion, that Republicans then blame Democrats and Democrats blame Republicans. It becomes a political issue. And society becomes increasingly divided. And we have a place down in South Palm Beach in Florida. And we've got lots of great friends down there, Republicans and Democrats. And some of these people can't even talk to each other.
Yep.
And they're all beautiful people and agree on 99% of the stuff. But they become labeled, right? Oh, it's your fault. No, it's your fault, whatever. But this is what happens. It is happening. And it's not just America. The world is becoming increasingly divided. And I really believe that, if you have financial security And not only from a country perspective, but from a global perspective, and the economy is deemed to be fair, that people look less to how can I take somebody else's wealth? Or you just become less angry. Like when you understand what's going on and what the motives are for people's actions, I believe great empathy comes with that as well. And
Yep.
I believe it gives us a much better chance of 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 fixing this, of steering it in the right direction, because the path that we're on um, is not going to lead to a good destination. It's going to end really badly, and um, and I think that we have a chance to decide how it ends. And if we just keep deluding ourselves, blaming Russia, whatever, um, that it'll eventually end in an out of control explosion.
Yeah.
And then we'll end up with something really, really bad, even way worse than what we have today, believe it or not. Or we have a controlled implosion where we decide to finally do the right thing, painful as it is. Um, and then we can move forward with a much better system. And I think, if people really understand what's going on and believe that we're all in this together, that it's not just me that's going to suffer and the top 1% will be fine, the government's going to be fine. No, we're all in this together, and they trust that we're all in this together. People will be willing to do the right thing. But right now, any policymaker um, who decides to do the painful but right thing will get voted out of office so fast because over the decades, they've convinced the people that you can have your cake and eat it too, that difficult decisions don't need to be made. So we just keep kicking the can down the road. They keep telling you that there's nothing wrong with Social Security. Well, guess what? On the current path, it's going to be insolvent in 2033.
Hmm.
So you got 7 years to fix this thing, but fixing it is not going to be a lot of fun. But if one party says they'll fix it, the other party says, no, we'll just keep it going. And so they get voted in, right? It's got to come from the people.
I used to work in a large corporation when I first got out of college. One of those corporations in that which once you're hired in, like they only hire internally. And what I used to see there a lot was you knew you were in a position for so long. If you worked hard, you could get within that position and get out with it within a year. And there'd be a lot of problems that you knew you had to handle, but you also knew if I could just hold it together for another 9 more months, I'll just like keep on putting more pieces of glue, more pieces of duct tape on it. I'll leave and it'll be the next person's problems.
Yeah. Yeah.
And as you were talking, I see that in our current political system. I got 4 years just to hold it together. I can
Yeah.
leave with my golden parachute, leave with my good name, and then it's the next person's problem.
Yeah.
And it makes me wonder if the entire system is built around this. The, we're failing from a policy standpoint because the incentives, the system is all backwards and it doesn't actually make for long-term progress.
Yeah. 100%. I mean, it's incentives. Charlie Munger used to say, you know, show me the incentive, I'll tell you the outcome, or something like that.
Yep.
It's not that complicated, but extremely difficult to change. But you can only do it with truth, understanding, a lot of effort, empathy, all these things. And and I believe that most people have all this. Well, they don't have the understanding, but they have the empathy and compassion. Most people are good people. Most people like seeing other people succeed and do well and be happy. There are always exceptions, of course, but most people are like that. You're out in a mall or something and you see like an elderly person and they sort of they fall down and like people come rushing from everywhere to help them up. I remember one time I was stopped at a traffic light and the light turns green and the cars aren't moving. You know what it's like. What the hell's going on here? You get pissed off right away. And and then only after I saw it was an elderly person with one of these walkers, and she had fallen just off, and she was trying to get up and she couldn't. And everybody was waiting for it to get up, and they could see finally she wasn't going to get up. And it was like a starting gun. Like 5 different cars, people just got out of the car and were running towards her to help her. It was an older guy here. It was an Indian woman there. It was, you know, people just want to help. It's there, and so let's put in place a system that brings more of that out rather than the divisiveness and the anger and the blame, and which we have more than enough of these days, and is not helping.
I don't want to make this a thing where we're blaming people and saying like it's their fault, but who are the people that have the power to make this change? And then what changes do they need to make in order to try to right this ship? And let me preface this a little bit. I meet with a lot of people, older individuals who, just like you said, like I made the right choices. I bought the right house because of how smart I was. I have this money now because I'm a genius and you guys never tried hard. And I think a lot of people, when they hear that, they have a feeling, right? Like the feeling is you're saying that I didn't do the right things. You're saying that I'm a crook or anything like that. And I don't think that my generation is saying that. They just want you to also realize like we are also trying as hard as we can. We did the right things. We're working hard, but we still feel like we're falling farther and farther behind. And what can we do to be able to like feel like we're making progress? And rather than someone who has all those things who made it, rather than them saying like, "Oh, I understand where you're at. Like that must be really tough. Let me help you." It
Yeah,
becomes a no, let me kick you down harder because I don't want to feel those bad feelings of it's my fault. When in
yeah,
truth, it's not. It's no one's individual fault. It's a system failure.
yeah, exactly. Yeah. Like you guys are eating too much avocado toast and stop buying those expensive lattes and all this other garbage. And, but it is to be expected, right? It is, again, human nature that, I've been talking about this for many years. As you can imagine, I've pissed off a lot of people. And I don't like pissing off people. Like I'm actually a people pleaser. I don't like confrontation. Like I get stressed out and have anxiety and stuff like that. It's so ironic throughout my whole career, I've pissed people off, and ended up in situations I didn't want to be in. But when I tell people of my generation this story, I'm very quick to tell them that they haven't done anything wrong, or at least they haven't done anything illegal. Like I benefited from the system and I didn't realize it at first. I just said, yeah, you get on the housing ladder and you make a fortune or you make good money. And but when I explain to them why it comes at somebody else's expense and why we don't deserve it, they quickly get it. Not everybody, but the majority of people get it. Every now and then I run into somebody who just can't stand it because their whole life they thought that they were a financial genius or a whiz in real estate, and yeah, I timed that well. No, you just happen to be older. You got lucky. You benefited from central bank policies that drove your housing prices higher. That's it. But most do get it, and most would be willing to see a change that would result in their house price going down. Now, the trouble is that, like I said earlier, these central bank policies discouraged people from saving as much money as they would have done otherwise.
Mhm.
So if their house price does go down, they're going to find retirement really difficult because they're not going to have nearly as much wealth as they thought they were going to have. And that's not fair either. And for some people who benefited from this, their house price going up, they're going to pass a lot of that wealth, or all of it even, to their kids. So the kids of people parents who did really well in the housing market and stuff will probably be okay. Like that whole line, choose your parents carefully, right? But a lot of parents are not in a position to pass that wealth down to their kids. They need it for their own retirement or their own healthcare costs. And a lot of young people have parents who don't own assets and are not in a position to pass that wealth down. And so, you asked, who's in a position to make this change? It's us. It's we the people. We have to demand it. Our policymakers will only do it if we demand it. It's political suicide otherwise. And that's why I do this sort of thing. And in my book, I talk about, in the acknowledgement section, I talk about a number of entrepreneurs who I have so much respect for, work so hard. They're real lifeblood of the economy.
Yeah.
And so these are the people who need to sort of raise their voices. They understand how an economy works. They understand what hard work is. Raise their voices and demand that policymakers stop taking these shortcuts, stop targeting asset prices, stop distorting interest rates, stop increasing the money supply at such a rapid pace. And yeah, and we will get there, but it's going to be painful for some. And I mean, I have a 10-step thing in my book about what we need to do to fix it. But none of those 10 steps can happen until the people demand it.
And I worry about that just because, we're living in a world that is increasingly more divisive. Most people are stuck into their phones and social media, believing that, they are certain who the enemy is. And,
Yeah.
we have left versus right, whatever word you want to use, but we have people sniping at each other. One of the guiding principles that I like kind of use in life when I'm unsure is human beings are inherently selfish. Like if you don't know why someone's incentive is, just believe that they are selfish,
Mhm.
and then you're going to pretty much know what's going on. So when you look at someone having to make a large group of people make the decision to do the thing that hurts right now, or just wait a little bit longer, kick the can down the road a little bit longer. In science and academia, there's an old saying that progress doesn't happen one finding at a time, but one death at a time.
Mm.
You have to let the old guard kind of leave so that so that the new guard could come in and change the systems to be like,
Mhm.
this didn't work for us. And then eventually that new guard becomes the old guard that has to get out of the way again. And might be the history that repeats. But I feel like we are at this fourth turning where it's like we figure it out now, or that we're going to have that explosion, and that explosion is something that most people don't even want to talk about. Like it looks like a civil war, it looks like a new world order, it looks like
Yep.
a lot of death and dismemberment, until the point that most people throughout history get to, where we've had enough pain and suffering that we're finally willing to make the change.
Yeah.
But most people aren't willing to make the change until they've had their pain and suffering.
True. Yeah, absolutely right. And there's an old saying that, don't waste a good crisis. Because
Hmm.
during times crisis, that's your opportunity to make the change because people are already suffering. I'm already in the water, so let it rain. Um, and it says, and they wasted the last crisis, by the way.
Yeah.
Absolutely wasted it, doubled and tripled down on these fallacious economic doctrines. And it's somewhat related, I guess, to the Schumpeter's, he was an economist, creative destruction, where you have to allow, business models to fail in order to create the next best model, or destroy your own customer value proposition to create a better one. And you do that sort of incrementally, and rather than all at once. But, earlier you mentioned, selfishness. And so two things I would say. Yeah, I guess we are selfish, but it depends on your definition of selfish. So at the end of
Hmm.
my
Yeah.
blog, it's a free weekly blog, I always sign off with be free and do no harm, right? And within that, be selfish. Do the things that you want to do. Do the thing that, turn your crank or whatever. Just follow your dreams and be free. Just make sure you're not imposing yourself on anybody else, and financially, physically, or emotionally. It's just hard to do, right? And it takes a lot of careful thought. Well, is somebody real? It's easy to convince yourself that nobody's harmed by your actions,
Yeah.
but really think about it. Be honest with yourself. That intellectual honesty, like I mentioned earlier. And the other thing I would say is that for selfish reasons, I think people should want to do this, because if they don't, things are going to get a lot worse. You just can't see it yet, but that is where we are going, no doubt about it. And so it's in everybody's best interest, apart from the top 1% maybe, but even then, even they will suffer in this new world order if we don't change it. So I believe it's in everybody's selfish interest to change this system. They just have to understand why.
Yeah. I think back to the French Revolution, right? Like the top 1%, like whose heads rolled first? First it was the
Yeah.
moderates,
Yeah.
the ones who said like we don't need a fight, and then it was the top.
Yeah. Yeah.
And
No,
it's
good
repeated
point.
itself throughout history
Good
over
point.
and over and over again.
Yeah. Yeah. Very good point.
So could you maybe like speed run for us, just for our younger audience to understand, and maybe for our older audience too, like how has the system benefited today's adults at the expense of the younger generations? Because I think we've talked about it over the last hour and 10 minutes, but we haven't like give a concise story that people can be like, oh, I get it. Like I finally get it.
Well, the the main way, I think, or the easiest way to understand it, is like we talked earlier about sort of the housing affordability crises that are occurring in most developed economies, where younger generation is putting off forming a family, starting a family, and global fertility rates are going down. This is really bad. This is really bad. And then the other main way is by distorting interest rates to zero and distorting the natural rate of interest. So instead of the natural rate, we have the neutral rate, which is down here. And this natural rate is the one that results in the most productive economy, which results in the most jobs being created, the most well-paying jobs. So there aren't nearly as much jobs today as there would be, because the natural rate of interest has not been allowed to occur. My favorite saying, my favorite line in economics is by an Austrian school economist called Ludwig von Mises. And he said that policymakers, and he died back in 1973 or something like that. So is a long, but these economic laws don't change. These truths do not change. He said that policymakers can deny you the right to receive this natural rate of interest, but they cannot eliminate its existence. They can deny you the right to earn interest on your savings account by taking the neutral rate down to zero to drive asset prices higher. But they can't eliminate the fact that it's this natural rate of interest that results in the most stuff being created in the economy, the most jobs occurring, the best paying jobs, the fairest distribution of the wealth being created, i.e., if you created it, you get it, right? Not at somebody else's expense. And that really is it. You know, I, like I said earlier, I'm not anti-government, and I think we should all be willing to help those who need help. But, within reason. Like, you don't want to disincentivize people from working. I mean, it's human nature. I get it. I don't blame them. There were times during COVID where people had more benefits than they could earn if they went and worked. So guess what?
Mhm.
They decide not to work. I don't blame them. There's another economist from the 30s and 40s, Benjamin M. Anderson, and I quote him in my book, and the line goes something like this. It says, any country can have as high unemployment as they're willing to pay for. In other words, you can have 50% unemployment if you're willing to be generous enough with other people's money and pay people to stay home,
Mm-hmm.
right? So, but this is not about demonizing people. This is not about calling people lazy because they don't want to work or blah, 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 blah. No. If you can't work for whatever reason, let's help. But if you can work, let's help you to work, right? But let's be humane about it, if you will, and compassion. And yeah, rather than encourage this attitude where you want to get as much out of the system as you can. And you can't blame people for having that attitude because they see this top 1% or top 10% that seem to be making out like gangbusters. And the system seems to be so unfair to me. So I'm going to take what I can. I get it. Right.
Yeah.
So let's change it.
Going back to my comment about people being inherently selfish, you don't really see that when there's times of abundance. If there's enough to go around, enough of the pie, people are happy. But in these moments of great populism, these moments of great upheaval, of great change, you start to see people. I like to, make it to like a suspension bridge. If you're on a bridge and you're walking and then it starts to shake, the first thing you do is you reach for something to grab it, to hold on to solidly.
Mm-hmm.
And I think that we all start to do this in these times of change. We start to reach and grab and try to hold and hoard and get as much as you possibly can because, the boat's sinking. I don't want people in my boat. Like, just get me onto my lifeboat alone and I'll be okay.
Yeah.
And, we have too much of this, I think, in this society.
Yeah. You grab on, you stop moving forward. Right.
Mhm. So, Paul, if tomorrow you could wake up, Magic Genie gives you the power to make change, what would you like to see happen in order to get us off of this precipice?
So, the first few steps that I outline in my book in the last chapter, I think are the most important. So one is stop distorting interest rates below the natural rate. So this would stop driving asset prices higher at the expense of everybody else in the economy. Stop increasing the money supply at a rapid rate. There's myth that an economy needs the money supply to increase in order to grow. It doesn't. Now, there are some will tell you that it does. Some people I have a lot of respect for believe that it does, but they don't think it needs a rapid increase in money supply. I think Milton Friedman used to talk something like 3 to 5% annual increase in the money supply. I could live with that. I still think it's distortionary, but and just a little bit more on that while we're here. So central banks will tell you that you need inflation for an economy to grow. It's so untrue. So in the last 30 years of the 1800s in America, the money supply was growing just over 4%, but it was this explosion of productivity in your country. And so the amount of stuff being produced was growing faster than the money supply. So the prices of all the stuff being produced necessarily was going down. So you had good deflation for 30 years. So even if you had a flat wage, every year you were becoming wealthier in real terms because your flat wage was buying more and more stuff. And this is the sort of the natural state of a free market capitalist system with a stable money supply. But we don't have that. Instead, we have the money supply growing faster than the amount of stuff. So the prices, there's more money per stuff. And so the prices of all that stuff grows faster. Now, a central bank will tell you, if you have deflation, now this is true, if you have deflation because of a contracting money supply, that's not good. So you want to make sure that doesn't happen. But if the amount of stuff is growing faster than the money supply, that's good. Don't stop it from happening. The central banks will convince you that deflation of any sort is really bad, and that gives them the excuse to drive interest rates even lower, increase the money supply, drive asset prices higher, make the debt value that government has borrowed go down. It's called financial repression, which we didn't get into, but maybe another show. And so they will use falling prices or low inflation as an excuse to print money, increase inflation. So the example I give in my book, and it's all nonsense. So the example I give in my book is if you had 2% deflation. Now, according to central banks, they will tell you that 2% deflation is catastrophic for the economy because you're not going to go out and spend your money because you're going to expect lower prices in the future. So you'll save your money instead of consuming it. And so I use the example of a TV. So if a TV costs $300 and there's 2% deflation, central banks will say you're not going to go buy that TV because you're going to wait for a whole year and buy it cheaper. So you're going to buy it today. Let's say you already have a TV, you just want another one for the basement. It's a real luxury. So you're going to buy it today for $300. Central bank will say no, that Chris is going to wait 12 months so he can save $6 and buy it for $294. No, you're not going to do that, right? But on the surface, it sounds intuitive. Oh yeah, if there's deflation, nobody's going to spend their money. Complete nonsense, right? So anyways, that little bit is an off-ramp there. So stop distorting interest rates, stop increasing the money supply, at least at a rapid rate. And the third one was, or is, that Wall Street needs to know that the Fed and the Treasury is no longer going to come to their rescue when they screw everything up. When they make bad investment decisions, they're going to be on their own and they're going to have to absorb the losses. Now, of course, Wall Street will come out with this false dichotomy, just like they did back in 08 and 09, that you can either bail us all out, I know it's distasteful, or global financial Armageddon. So these are your two choices. No, there were other choices. But of course, politicians, they love to hear that because the bailout immediately sends stock markets soaring and stops house prices from going down. All the asset owners are happy. Politicians are happy. You're feeding them exactly
They
what
get reelected.
Yeah, exactly. Reelected, exactly. So if they just did those three things, natural interest rates, stop increasing the money supply, and no more bailouts for Wall Street. I mean, there is so much reckless, leveraged speculation going on in Wall Street because they know if they blow it all
Well,
up.
they're playing with funny money. If they fail, who cares? It's like it's heads I win, tails you lose. I'm just going to keep
Exactly.
going for it. Why
Exactly.
not try?
It's socialism for the top 1%, as they call it. And the Fed will come back and QE4, well, some say we already have QE4, QE5, I guess, and print trillions of dollars to bail them all out. It's got to stop.
I'd like to just quickly speed run for our younger listeners because I know I hear it often in my coaching, often from our comments of, I went to college, I got the job, I'm doing everything that I was told to, and I feel like I'm still farther and farther behind. And people just don't understand the mechanisms. You have to listen to a whole hour and a half long podcast to understand the mechanisms, and people just don't have the attention span to be able to do that. So in order to do that, I'm just going to give a quick background, and then please, Paul, check me wherever I'm wrong. But essentially think no matter how hard you work, no matter how much money you make, and say you get out of college and making $100,000 a year, that should be enough. But no matter how much money you make, you look at it, you say, prices are going up. People keep on telling me my taxes are lower. And I don't understand, why is my money not making the same amount? And it's because there is a secret amount of money. Inflation is saying it's like approved theft.
Mhm.
Rather than saying, I'm going to tax you more, I'm going to take more of your money, the way I'm going to tax you is just by printing more money and making you reduce your buying power. But I'm going to spread it amongst everybody. So no one really knows what the hell is going on.
Mhm.
They just see I'm making more money, but it's buying less and less and less stuff. And then rather than understanding those two mechanisms, they just told just because you're lazy, it's because you're not trying hard enough. And to anyone that's listening and saying like, that's the situation I'm in, it's not your fault.
Yeah.
And it is your responsibility. It is our responsibility to get ourselves out of that. So, Paul, first off, did I mess anything up there? And then
Perfect.
second,
Perfect.
if you are in that situation, if you are that person who's like, I feel it, I know exactly what you're saying, and I don't know what to do. I'm only one individual. Because I fear that most people are going into this other place, especially in the younger generation, of nihilism, of I rather not play the game because I know that I can't win it.
Yeah.
But if we all decide that nihilism is the correct view, we will, like the explosion that we will have will be just catastrophic.
Yeah.
I need people to feel that sense of hope. Like, there's an old thing saying like it's the hope that kills you, but it's also the hope that gets you out of bed. It's the hope that allows you to drive for a new day.
Exactly. I was talking about this yesterday with somebody. They asked me for one final comment. My final comment was, "Don't give up. Don't stop trying." This whole YOLO or lifestyle, and it's totally understandable because they look at what a house price is. They calculate how much they have to save each year to afford a down payment, and it might take them 25 years to come up with a down payment. And even then, they might not qualify for the mortgage because they don't earn enough. And
Hmm.
so they said, well, it's hopeless. So I might as well just spend my money now and live my life.
Or
For
the price will triple in the next 20 years in order to
Yeah,
save it.
yeah. And so I say, don't give up on the dream. Um, Continue to save, invest your money carefully. Also, by the way, continue to live your life today. Life is happening now. There's one, I'll give you one quick story. Like all my clients were financial advisors, and this one advisor, we were talking about how, encourage clients to be responsible to save so they have enough for retirement. So she had this one client. He was a laborer in his 80s, passed away. His wife was coming to see the state of the finances. She had no idea, right? He old school, he did everything. And the advisor was saying, I couldn't wait for my client to come and tell her the good news, right? He saved a lot of money. So she says, first of all, your house is paid off. Second of all, you got over $1 million of investments. You're not going to have to worry financially the rest of your life. Her client starts crying. She's upset. The advisor says, what's the matter? She says, all I ever asked for was 2 weeks in Florida.
Hmm.
You wouldn't spend the money, right? So you want to strike that balance, right? And but don't give up, and educate yourself about this kind of stuff, and talk to your friends and spread the word. And I mean, it's easy for me to say, but it's in everybody's best interest, particularly the next generation, to do this. And financially, if we fix this system, I'm going to suffer. But I'm totally okay with that because I think it's the fair thing. Now, we've made money on our homes. We're going to give it to our kids so they can afford to buy an overpriced home, from somebody else. But yeah, that would be my message. And yeah, I really don't know what else to do, Chris. But I'm going to keep doing it.
I think that's all we can do is just keep trying our best. Like, I don't think anyone knows what the answer is, but I think just trying to go out there and every day feel like you're making progress. Or you're trying to grow human consciousness, trying to grow
Yes.
to a better system rather than staying stagnant. Like we as human beings, we as all creatures, it's we will continue to try to grow. Like without that, stagnation is truly is death. So, Paul,
That's a
thank you
great
so
line.
much
I'll
for.
just say, Chris just said, grow human consciousness. That is a great line. And I might steal that from you.
You can have it.
Thank you.
So, Paul, thank you so much for joining us here on the Five Guys podcast. This has been a very engaging conversation. To our listeners, if you got any value from Paul, oh, I'm so sorry, Paul. Where can people go to find you if they want to know
Yeah.
more information?
Yeah, sure. Yeah. And thanks, Chris, for having me. I really enjoyed this conversation. I have a website called paddingtoncapitalmgmt.com or paulitical So it's my first name, paul and people can go there, and I've got all my past posts. People can just put their email in and they will get a weekly free post from me. No catch, no credit card, nothing. And I've got lots of past interviews on there. a link to my book if they wanted to buy my book, which is Capital Offence: Why Some Benefit at Your Expense. It's available on Amazon, Barnes & Noble. Thrift Books, I think, has it. And there's also an Audible version, so if you like listening. And on my some outfit recently did a 1-hour summary of my book. I'm going to have that on the website as well, so you can listen to the shortened version. But yeah.
Wonderful. All of that, Paul, if you share it with me, I will put that in the link. So
Okay,
for our
yeah.
listeners, all of that will be in the link down below. But Paul, thank you so much for joining us. To our listeners, please, like Paul said, remain hopeful. Like you're going to create the world that you envision. So please try to remain hopeful. I know it's hard, especially in these types of times. I'm going through it myself, and I try to remember every day to just stay hopeful. And please share the Fi Guys, share this podcast with one person who you believe needs that hope, who needs to have a better understanding as to why they feel the way they feel, so that they can have hope that it can get better. So, Paul, thank you so much for joining us. To our listeners, thank you so much for being here, and we'll see you on the next one. This video podcast is sponsored by Monzon Wealth. The content in this podcast is for informational purposes only and should not be considered financial advice. We do not endorse specific products or services. Past performance does not guarantee future results. The opinions expressed are those of the hosts and guests, not the podcast sponsor.
It is crucial to consult with a qualified financial advisor or professional who can provide advice tailored to your specific needs before making any financial decisions, investments, or taking any other actions. If you are seeking specified help, you can reach out to Chris at monzonwealth.com.